All right. Welcome back to the Know Your Numbers REI podcast. Chris McCormack here, CPA, certified tax planner at Better Books. It is our goal to help you, the taxpayer, eliminate the frustration, ease the overwhelm, limit the chaos so that your taxes are not only prepared, but prepared to the place of lowest tax possible, giving you the peace of mind, the confidence to move forward with your real estate investments, your business journey. And we do that through tax planning and education, just as we're here on the podcast. So I thank you for joining us. I would ask if you get any sort of value, or if you haven't subscribed, you do that. If you get value and you want to share it with a friend, go ahead and do that. Give us a 5-star rating and review. It is such a blessing, and it goes a long way in teaching the algorithm what to do. So today, we're going to be talking about the source of taxation. 4 primary drivers of your tax bill, the source of your tax bill. And the reason I want to talk about this is because the wealthy know a thing or two about taxes. And one of the things that they know about it is that the way that you receive your income makes a large difference in the amount of your tax bill. And so if you're receiving your income in a certain way, going to pay more taxes than if you receive your income in another way. And the picture perfect example of this would be Warren Buffett. There's been articles circulated about Warren Buffett having a lower tax percentage than his secretary. He pays a lower percentage of his income in taxes than his secretary does. He doesn't pay a lower amount of taxes than his secretary, but the portion of his taxes is much lower. And then the margin, obviously, he makes however many $1 billion a year. He pays a certain amount in year, and then the amount made minus the taxes leaves so much more left over than if his secretary, who doesn't make $1 billion a year and pays a higher amount of taxes. So this has real world implications for you. You're overpaying on taxes, and a large part of that, or large reason behind that, could very well be because you are taking your income in a certain way when it would be more beneficial to do it in another way. So we're going to dive into it. The 4 primary drivers of your tax bill. The first one is how you make money. Again, Warren Buffett has claimed to pay a lower percent of his income in taxes than his secretary. And most people think that's bonkers, think that's wrong, it's unfair, it's unjust, but it largely comes down to because he planned to make his money in a certain way that gives him a low tax bracket, likely the capital gains bracket of 15 or 20%. So W-2 earners, those of you who are W-2 earners, have the least amount of tax saving opportunity, right? So one way to make money is through a W-2. I know of ways that we can create tax savings through your W-2, and it usually helps to have a large amount of W-2 income to do it because they require a cash outflow. But the point is that W-2 earners have a very limited approach to what they can do on the tax side of things. They can't get all the deductions that a business owner can have. They don't get the depreciation that a real estate investor has. The standard deduction is more beneficial for most people than the itemized deduction. So that takes away a lot of their deductions that they've had in the past. That was because of President Trump's Tax Cuts and Jobs Act. He increased the standard deduction. And now some of those changes are going out the window here in a few years, but I believe the standard deduction will stay. I can verify that for a future episode. But W-2 earners have the least amount of opportunity when it comes to their taxes. Now, if you're a W-2 earner, you're listening to this, you're thinking about investing in real estate, or you want to consider ways to save on tax, reach out to us. We'll help you, because a lot of CPAs will know this, that W-2 earners have the lowest amount of opportunity to save on tax, and so they won't approach W-2 earners with any tax saving opportunities. But we have saved some of our W-2 earners over 6 figures in taxes in just the past 2 years, and we're going to do it again this year. And so if that's you and you want access to these strategies, reach out to us. We can see what we can do on a tax planning side. Now, real estate investors and business owners have much greater opportunity, right? I alluded to this when I was talking about business owners get a certain deduction. We have the ability to write off our travel. We have the ability to write off our supplies. We have the ability to write off our continuing education, some of our meals, some of our coffee, some of our car and auto deductions, right? All within a certain parameter. But these are deductions that many people take as just regular Americans, regular taxpayers, but business owners are able to use it as a business purpose and get the deduction. So you save on tax. You can make $250,000, deduct $170,000 and get taxed taxed on $80,000. Whereas if a W-2 earner makes $250,000, they might spend $170,000, but they're still taxed on the $250,000, and it results in some tighter pockets. So business owners have great opportunities. Real estate investors, right? If you're new to this platform, you might not be as familiar with real estate, or you might not know that we are real estate focused in the tax avenue. That's not to say that we don't take on business owners. Again, we look for anybody who might be overpaying and frustrated with their tax bill. But real estate investors get the bonus depreciation. They get the benefit of writing off their utilities and their mortgage interest and their property taxes and their insurance. And so all of this usually allows them to take losses or have a lower amount of income than they would, because depreciation is an expense that they don't have to pay for. They likely bought the property, they use debt to finance the property, and now they get write-offs for the deterioration of that property, when in reality that property is appreciating. So real estate investors and business owners have a great amount of opportunity. Again, I've talked about Warren Buffett here. He does it because he classifies his income in a specific way. I believe he takes dividends. So his dividends are taxed at the capital gains rate, whereas his secretary is taxed at the ordinary income rate. Whereas the secretary might pay 24 or 32% of her income in taxes, he's paying anywhere from 0 to 15 to 20% through that capital gains rate. And he has some taxes on top of that, the net investment income tax and other taxes that pop up. But the point being is that the way that you make your money, if you're making your money completely on dividends or interest, you're not going to be taxed in the same way that somebody who's making it on a W-2. If you're making it on real estate or through your business, same thing goes. You're going to have a lot more benefit than what somebody who's just getting a W-2, plugging away at their job, is getting for a tax savings opportunity. The second driver of your tax bill is how you save money, right? And we talk about different ways to save. We talk about retirement accounts. We talk about high yield savings accounts. We talk about life insurance, retirement plans, cash value life insurance. There's pension plans. How you save money is a huge driver of your tax bill. I can put $50,000 in a high yield savings account and get interest on that, but I will pay taxes on that $50,000. Whereas if I take $50,000 and put it into a tax-deferred retirement account, I won't pay taxes on that. Now there's tax consequences in the future, and that's a whole nother subject, but it depends on what your goals are, right? If you are of the branch that you want to save for the future and have something in a retirement portfolio and you want to pay low amounts of taxes now, a 401k or an IRA or a tax-deferred retirement account could be an option for you. Now, there are drawbacks, as I alluded to, that being that taxes in the future aren't accounted for, right? I can get a tax deduction for 24% of my income this year, but then if I withdraw and that tax rate is now 28% or 32% or 50%, God forbid, well, then I ended up paying more in taxes because what was 24 is now 50% and I'm in a loss position. So there are ways to save money and decrease your tax bill now. There are also ways to save money and increase your tax bill in the future, right? Cash value life insurance is a way to put money aside, save for the future, and also get potential tax savings in the future. You won't get tax savings now, right? Be careful when you go into these conversations. They might frame it as a tax advantaged asset, but it's not tax advantaged in the year of payment. You can't write off life insurance policies except for a few small exceptions, and you can't write off the overfunding of a cash value life insurance policy. So those two don't get you the deduction now, but in the future, you can store a certain amount of cash value in these policies, and then you can withdraw it, take policy loans, and get tax advantages from that. You get it tax-free because they classify it as debt, the IRS does. So how you save money is a big driver of your tax bill, not just in this year, but in future years as well. How you invest money is huge too. This is number 3, the third driver of your tax bill. How you invest money has to do with where you're putting your money away. Are you putting it into a stock portfolio? You are, okay. Well, then we're going to have to consider capital gains, right? Largely, when you think about your stock portfolio, if you're a W-2 earner, you've paid taxes on that money that you're putting into your stock portfolio. Now you're using after-tax dollars, you're investing it, and the money that you make on that principal, on the basis, on the nest egg, if you will, the money that goes up in value, you pay taxes on the capital gains. So capital gains tax will be lower than ordinary income tax for most people, but you're still paying taxes on it. Whereas if you put money into an IRA, a self-directed IRA, invest it in stocks or Bitcoin or real estate, you don't pay taxes on it until you withdraw the money. And then you get the tax deferral in the year that you would contribute. And then you get tax advantages while you're adding it, while it's increasing in value and you're buying and selling in the portfolio. And then you pay taxes on it in the future. So how you invest your money, if you invest your money in real estate, you're going to get some tax advantages. you're going to get the depreciation, you're going to get the insurance, you're going to get the maintenance, you're going to get the utilities, you're going to get the interest payments, you're going to get all of these expenses as deductions, and then you're going to get a loss on your real estate potentially, and then that can be used when strategically planned around to offset a lot of your income. So how you invest your money has a huge factor in your tax bill, both now and in the future, right? Oil and gas is another one, right? If I'm investing in oil and gas, we've talked about this in the past, but if I'm investing in oil and gas, yes, there's risks involved, but also there's benefit. The oil and gas, the amount of money you contribute to an oil and gas field or fund, depending on the type of investment, you need to make sure that you're making the right investment, but there is as high as 70% of that investment, actually as high as 85%, if I'm not mistaken, can be written off in the current year. And so if you are investing in oil and gas, you're getting more tax benefits than if you're just investing in stocks and bonds in a stock portfolio. Now, there's taxes on the money that comes after the oil and gas appreciates that we have to consider, but there are tax benefits, and how you invest your money largely determines what happens when you approach your tax bill. And number 4 is how you leverage money, right? I talked about the life insurance policy, the cash value life insurance. I can take a loan out once I develop a certain amount of cash value in that, and that loan will come to me tax-free because debt is not taxed, right? So we have leverage. We have loans, mortgages that you take out on your real estate properties. You can take a mortgage out and you get that money tax-free. You can use this property that you now have at your disposal. It starts the cash flow, and then you can rehab it and refinance it. And then all of that leverage, all of that debt income comes to you tax-free. So you have leverage, right? The tax code is very friendly to leverage and debt and financing that comes up when it comes to buying investment properties or using cash value life insurance and policy loans to fund your lifestyle. So the 4 primary drivers of your tax bill: 1 is how you make money, 2 is how you save money, 3 is how you invest money, and 4 is how you leverage money. When you consider your taxes, you want to make sure that these 4 things are being considered in your tax plan. You want to make sure that these 4 things are being talked about with your advisor on a regular basis. You don't want to be making these decisions on your own. I've seen people that have leveraged money properly, but they've recorded it improperly. And if it weren't for the way that we reviewed their books and saw what was going on, they would have paid taxes on that money. And it would have been a mess, and they would have overpaid, and they would have had no idea because they just assumed that everything was happy-go-lucky. So don't be one of those people. These are the 4 primary drivers, but you also need to be in the right team to make use out of this information and to advise on what the best thing is for you, how you save money depending on what your goals are and where you want to go, how you invest money depending on what your goals are and where you want to go, how you make money depending on where your goals are and where you want to go. It all plays into it, and you have to have a relationship with somebody who's going to help you see it to the end. So I hope this was helpful. I trust you guys got value out of it. Looking forward to hearing some of your points and reflections. If you did get value, again, leave us a 5-star rating and review. If there's anything that you guys want to hear about, join our Facebook group and start to comment and ask questions and consider what it is that you need answered, and you might just find that we have an episode for you. So until next time, God bless you and keep moving forward.